And it really boils down to one word describes, it's multifaceted, but describes the overall reason you would choose floating rate debt over fixed rate debt, specifically that you're securing with real estate you may own. And that's flexibility. Floating rate debt provides you with more flexibility than fixed rate debt does. Long-term, non-recourse fixed rate debt that you might tap into in the capital markets carries with it prepayment provisions, because those investors expect, and it's priced such, you get great fixed rate because prepayments protected. They can count on that fixed rate of interest for a certain period of time, right? And that's done through yield maintenance, defeasance, lockout periods. It's a less flexible piece of debt in terms of payoff. The other thing that floating rate debt will often have, if you like the idea of fixed rate, it may even have an ability to convert to fixed rate. So you have prepayment provisions with a piece of floating rate debt that typically, it's typically 1%. You'll pay 1%. There's not a complicated means of paying it off, and you have the flexibility to convert to a fixed rate loan, and often it's shorter term. And so you're going to seek that floating rate debt because your real estate may be transitional. Maybe you've got construction loan to build it, or rehab loan to do some work to it, and then you're going to have to focus on leasing it in order to get it stabilized and ready for that piece of long-term debt. You put it to bed with, a 10-year fixed rate loan once you get those things achieved.